Greetings, members one and all of the Salivation Nation. According to an analyst, gold won't reach $1,900 until 2022. Let's explore. As most of us are well aware, 2020 saw a record price for gold in real dollars. It spiked up above $2,000. And many of us feel like this year that the price is going to top that same level again. But this year is very different than last year. Now, obviously, we are still on the coattails of this pandemic and how the economy and how the market is reacting to it all around. And, as this recovery starts to take place, we are in the tailwinds of quantitative easing, where they've essentially digitized and distributed and printed a bunch of dollars out there and distributed some of those in the form of stimulus checks to many American citizens here in the United States. The dollar as the world's reserve currency is under greater threat now than ever before of increased inflation. As you know, inflation is a normal part of the economy these days, and it has been really ever since the inception of the Federal Reserve in December of 1913. And the dollar has lost, well over 98% of its value since then. And that just goes to show you that we are in a time where we're seeing the dollar kind of lose value by design, and even as such, there's a threat of it that it could be runaway inflation, which may not necessarily mean hyperinflation, but still, it's concerning, and it's now being talked about and bantered about in the circles of different news outlets out there. So, what about this analyst? Before we talk about that, let's take a look at the prices. We see that gold is up a little bit today. Silver down. Of course, that's going to hurt the gold to silver ratio, which is still under 68, but it is a high 67.87. So gold price did settle based off of the Fed policy decisions. So let's take a look at the markets here. What happened here? Gold futures ended slightly lower on Tuesday, with prices sticking to a tight trading range as investors awaited the outcome of the Federal Reserve's two-day meeting on monetary policy. Right now, gold prices only care about the Fed, and they're stuck despite U.S. consumer confidence hitting a pandemic high, home prices jumping the most since 2006, and as other commodity prices surge, said Edward Moya, senior market analyst at Oanda, in a market update. The two-day Fed meeting, which concludes Wednesday afternoon, is expected to see policymakers maintain their stance that they can wait until 2024 for U.S. interest rate increase. They originally said 2023, but it looks like they're holding off. And they've been pretty bullish on the economy, they think. But obviously it did not keep gold from climbing a little bit. But this analyst thinks it's going to be a while before we see it get to any numbers anywhere near what we saw before. It's too early to even start talking about tapering. It's $120 billion per month in asset purchases, otherwise known as quantitative easing. They call it QE to infinity now. They just keep on pumping out those dollars. A rise in U.S. consumer confidence put some pressure Tuesday on prices for Haven Gold. The index consumer confidence climbed to 121.7 this month from a revised 109 in the prior month. That means potentially more money flowing through the economy. The velocity of that money, as it increases, does increase the threat of inflation. So we'll see how that plays out. But let's see what this article is about from Kitco. The gold price won't push above $1,900 until 2022, according to Marenfield and Company. So they are somewhat bearish on gold. At least, I don't know. When gold doesn't really move a whole lot, what do you call that animal? A sloth? You got the bears, you got the bulls, and you got the sloths, maybe. Maybe they think that the gold will be in a sloth position. The article says here that not only has gold struggled to find enough traction to break above $1,800 an ounce, but one market analyst is warning investors they may not see $1,900 an ounce until next year. They were interviewed by Kidco News. Chantel Sheevan, head of research at Murenbield and Company, said that while she is bullish on gold in the long term, the precious metal has some challenging headwinds for the rest of the year. This is the first time I've seen more of a prediction that it wasn't going to get up into the high 19s or even $2,000 level. My prediction, by the way, kind of falls in line with some of the other analysts out there. I think it's going to hit there. The research firm recently updated its gold forecast for the second quarter and expects prices to average the second quarter at around $1,806 an ounce. Gold will see incremental improvements in the third and fourth quarters with an average price of $1,827 and $1,865 an ounce respectively. So they still are bullish on it, just not to the level that many of us think. Murenbield and Company doesn't expect gold prices to rise back above $1,900 an ounce until the first quarter of 2022, and the analysts don't expect prices to hit new all-time high until the second quarter of next year. She even said that she is relatively neutral on gold in the near term, as central banks now appear to be in a holding pattern, waiting to see if all the stimulus they have pumped into the system will lead to a sustained, robust recovery, and also rising inflation. She even added that the latest spate of economic data does point to expectations of strong growth. However, she also noted that the Federal Reserve has been clear that they want to see actual growth and not react to forecast. She even added that there is still a lot of uncertainty surrounding the path of the pandemic. It's not a given that the current pace of the recovery will be sustainable, she said. And again, that goes to show you that the Federal Reserve, we want to talk about manipulation. Well, that's what they do. They want to manipulate the economy using their modern monetary theory, which I refer to as moronic monetary theory. For the gold market, another significant uncertainty holding the market back, if it is robust growth, will lead to rising inflation. There it is. She even notes and admits here, while it's a given that base effects from last year's COVID-19 economic crisis will lead to higher inflation in the next few months, she even said that investors won't know until the end of the year whether inflation will be more than transitory. Jerome Powell thinks it's just going to be a one-and-done type thing. It may rise a little bit, but it's going to recover. It's going to be fine. Yeah, of course, that's what he's going to say. She even said that she is paying attention to the amount of money circulating in the U.S. economy, also known as the M2 money supply. That is a good thing to pay attention to. We're starting to see that momentum. People are thinking about what they want to do, how they want to spend their money, traveling, vacations, going out to eat. We are definitely seeing it in the housing market. Yeah, housing prices are sky high now. So are the materials to build them. Essential commodities such as copper, lumber, food, they're all rising. Even if some of the momentum subsides and moves sideways, you're still at a higher price level. Keep in mind that some of the supply chains are still recovering from this thing, and I think that's part of what's leading to these increased prices in these commodities, which, by the way, you can add silver to those as well. She even added that the rise in commodity prices is very concerning for long-term inflation pressures. Higher prices are increasing input costs for companies, and they, in turn, are passing those costs into the consumers. There you go. That's right. It's economics 101. Inflation is coming, but it could be 2 or 3 months behind producer prices, she said. Yeah, and I agree. I think these high prices we're seeing here now are really not due to inflation, but inflation is obviously a part of it, a greater part of it, but especially for lumber and copper, yeah, I think that's a lot of it is due to the supply chains and the like. While inflation appears to be the biggest factor to drive long-term gold forecast, Sheen said that it's not the only factor. She said the gold continues to be an attractive safe haven asset as equity markets continue to trade at record valuation. She noted that rising inflation pressure could weigh on equities. We are already starting to see some volatility in equity markets, and it wouldn't take much more to impact equity markets, she said. However, on the downside, she even noted that along with the improving economy, the gold market continues to face tough competition with Bitcoin. She said that according to research, the rally in Bitcoin has reduced gold's market value by 2.5%, and that's really shouldn't surprise a lot of us. There's a lot of excitement in the cryptosphere, but however, some of that excitement has also spilled over into the precious metal space, and I'd be very curious to see what has been added to gold and silver market because of the excitement in the cryptos. But nonetheless, it is what it is. That's a space I'm still kind of hold out and really don't get involved in a whole lot. It's very speculative even now. For those of you who are in it and seeing great returns, congratulations to you. I think there's many ways that gold serves a different role than cryptocurrencies. Really, the only thing that really ties the two together would be decentralization. However, it should be noted, and I think most will agree with this, because I think I even mentioned, even though it's not being tracked by governments now, it could be tracked. And because of what it is, the background, the basis, the foundation for cryptocurrencies is a blockchain, and that is a ledger system, which means that transactions are tracked. Maybe not to any individual, but it wouldn't take much to tie them to individuals, and if governments get involved, all bets are off. Gold and silver cannot be tracked. So there you have it. Let me know your thoughts in the comment section below. Very interesting indeed. Where do you think gold is going to go this year? Is she right? Is she wrong? A lot of factors could come into play to blow it all up in either direction, really. So I'd like to extend a multitude of gratitude to you all for taking the time to watch this video, and encourage you to please rate, share, comment, and subscribe.